Let's start our conversation where we often do, which is with bonds. We see a little bit of a tick up in bond prices today after quite a sell-off. But again, given how much we rallied, it's like nobody really cares about it so much. Tell me what's going on. Tell me what you think.
Yeah, a lot of people are asking the same question. Why? Is it just a simple retracement from yesterday? Was it a large rate hedge from the Saudi Aramco deal from yesterday? Was it something else, like looking forward to CPI or FOMC minutes? Nobody seems to know right now. We're stuck right around 2.5, a little bit lower than that actually in the 10s, waiting for tomorrow's number and minutes.
Yeah. So, I'm glad you to bring that up because we've got minutes tomorrow. We haven't even started talking about that yet here today because there's been a lot going on the stock front and more. This morning also for data, right? We had a little bit of a weak jolt. I mean, optimism was fine for small business, but now following up from last week, we're still soundly in negative territory as far as economic data surprising goes here in the U.S. Should that keep a bid into the bond market?
Yeah, it definitely is. I mean, I think the bond market is just showing or demonstrating just the the weakness in the global environment. I mean, I don't think the market is as rickety as it is, maybe even more resilient than rickety. That's what I'm trying to say. But it's really hard to like the market when you see global manufacturing continuing to slide. Europe hasn't found the floor. But there are bright spots, and there has been. And I think it's just a temporary respite, and I do believe, especially medium-term yields are just demonstrating that.
Now, is the data really, a catalyst, or is it just Fed speak? And I know maybe it's kind of splitting hairs sometimes because we're led to believe that, the two are closely aligned as they watch the data. And I'm not disputing that, Larry, but, even if we start to get some nice prints here, unless the Fed gives any hint of changing their, accommodative direction, does it really matter? Can we get strong growth here and still have yields at 2.5%?
I don't think we can. I mean, what I think can happen, and won't happen for a while, is that we'll just get a continued inflection higher from China, which definitely will benefit the market, definitely benefit Europe, and that's one of the biggest issues we're having. That's what's holding us hostage with the rates that we see today, was that Europe just cannot find a floor. When you look at the broad swath of data that's out there right now, it's not all terrible. I mean, we see 2 months in a row of global services PMIs ticked higher. China data overall has been decent, and figure it out. Japan, U.S., Germany, employment figures are all good. So with all that said, we could see higher yields. It's just going to take a lot of doing for that to happen. Yeah.
All right. We're going to talk some more about the ECB in the next block, too, because that might be the big event of the week. But I don't know. They're pretty stalwart in their own dovish turn. Hey, Larry, you want to talk stocks for a sec? Because you wrote on my Twitter yesterday about earnings. My point coming into earnings season was that I'm kind of joking about it being like the first earnings season in 6 months, Larry, because the market was embroiled in the sell-off in Q4 as they were reporting Q3, and then in this huge macro-driven rally where no matter what companies did last season, they rallied. We had like one of the most record-setting gains for companies that had double misses, going back years. What say you? What are you looking at over the next couple of weeks here?
Well, next couple of weeks, I'm looking at the qualitative aspect of the earnings season. The bar is significantly lower than it was even 2 weeks ago. Earnings per share down to $180 for 2020. Assigning a 16 times multiple to that gets us to 2,900. That's why we continue to hit that ceiling in the S&P 500. I firmly believe that we'll see 3,000 by the end of the year, but it's going to take some hard doing. It's going to take a lot, and I think this earnings season is going to help, pave the way for that. But it's qualitative part of the earnings that I'll be paying attention to. Yeah.
Do you think that, given how much the stock market has come back, though, that maybe there's sort of like a whisper number that's almost higher? It's like when you come, 20% plus off the lows into earnings, with all the negativity out there, it seems like people have become very comfortable despite that. They say, hey, you know what? It's only one quarter. They're going to give us improved guidance for the rest of the year. It's going to be all right. I hear this narrative a lot.
Yeah. Exactly, and that's the point I'm making with regards to the qualitative aspects of the earnings season. For instance, banks, a lot of them start reporting on Friday. I think it's going to be a sleeper. Net interest margins are going to be flat. Everything's going to be flat. But it's a qualitative looking forward to what's going to happen, the second half of 2019 that will drive the market. And that's why I think that, adding or assigning a 16 times multiple is about as aggressive as the market will allow at this point until there's more clarity in the earnings season. And if we get some type of, deal done in the near future with regards to China.